Another day, another dollar, and another new all-time high for the S&P 500. Markets rallied, stocks, commodities, crypto, bonds, everything under the sun after Jerome Powell's dovish comments at the ECB conference sent yields lower, and the market completely ignored some of the weaker data we received today. And like my father always told me, when it comes to people, take humans at their actions, not their words. So when the data acts one way and the Fed says another, who exactly do we believe? Today, I'm bringing you the stats and the data, telling you exactly where the market is going and showing you the likely outcomes. We'll be diving into earnings, market breadth, and seasonality to give you the latest and up-to-date data. So who exactly should we believe? And is this the end? We've got a lot to talk about. Let's roll the tape. Welcome everybody to the daily recap show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell, like this video, and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500 and a lot of green in a lot of sectors, except Nvidia down 1.31% and healthcare, at least the growth section of healthcare, not doing so good, but the defensive side not too bad as well. We did see a little bit of weakness here in discretionary on the apparel side as well as restaurants, but Tesla and Amazon held up the show, up 10% here on the Tesla delivery numbers, as well as Amazon up 1.42%. But they weren't the only big boys taking charge. Google, Meta up 1.15% and 0.95% respectively. Apple up 1.62%. Same here with Microsoft up 0.5%. It was a really bullish day in tech, excluding Nvidia. I mean, even semiconductors on an equal weight basis, super bullish, as well as software. So it was definitely a risk on day, but not in like growth sectors or risk on sectors. It was just a risk on day in equities. It was an everything rally, excluding a few sectors that actually rallied yesterday. Like this section here in restaurants and apparel were up yesterday. Go look at the charts, and same with this section here in healthcare, the growth sector of healthcare. But very bullish across all sectors and all sizes, except for energy, which was down 0.1%, healthcare, and home builders. Other than that, you know, we saw about half the sectors beat the SPY, stuff like staples, metals, communication services. Semis even beat the SPY without participation in Nvidia. Just shows you the strength we're seeing in that sector. And we are starting to see a rotation from Nvidia into the other names. I still think a lot of the other semi names have a lot of legs to run. Nvidia is probably fairly valued at this point, but still a lot of room left to go here in semis. Then we saw stuff like XLF, financials, regional banks, discretionary, all up greater than 1%. Very bullish day. But even the sectors that underperformed the S&P 500, look at stuff like XLI, industrials, software, technology, utilities. You still take these gains whenever you can. And it was a broad-based rally here today. The S&P 500 saw 341 gainers, 159 losers. The Russell 2000 saw 1,131 gainers against 850 losers. So it's a very bullish day, particularly in the large size segment of the market. You can see that large cap growth was the best performer, but even stuff like small growth, small value did really well. It was green across the board, broad-based rally, but definitely growth at a reasonable price and growth in the large segment was the real winner. And the reason why we rallied today had to do with the number of data points. The first actually had to do with the JOLTS numbers. So we got the JOLTS quits and JOLTS openings. Now JOLTS quits actually came in at 3.4. We're expecting 3.5, which means less people are quitting their jobs, but the market seemed to brush that off because job openings came in better than expected. And pretty much what this is telling us is that if people do quit their jobs, they're going to be able to find a job because there's more openings than there were last month. We also got the Red Book Index that came in at 5.8%, pretty much a barometer for the consumer. And this is just telling us, you know, there's no real weakness in the consumer just yet. That's a very strong number. And then to top it all off, we also got Jerome Powell's speech. Now he came out and spoke at the ECB forum. And when he says stuff like we are getting back on the disinflationary path, when he says data represents significant progress, if the labor market unexpectedly weakens, that would also cause us to react. When he says stuff like inflation may get back to 2% late next year or the following year, or the labor market is still strong, you know the markets are going to look at that and rally. And this is all stuff he's already said before, but when it comes out of his mouth in the present, it just reaffirms bullish momentum. And that's why we also saw the fear and greed index go from the fear zone 43 just yesterday into the neutral zone here at 48. And that just represents broad-based buying across sector and size. Remember, on Friday's video, I went into what makes up the component of the fear and greed index, and 2 out of the 7 components, which is 30%, is market strength and market breadth indicators. And when breadth improves, you're going to see this particular indicator improve a lot. And if we continue to see the sector and size rotation with large caps not necessarily leading but rallying as well, you're going to see this indicator push from the neutral zone into the greed zone very quickly. Now the S&P 500 was up 0.62% today, and let's actually do something very interesting, something we don't usually do. Let's look at the daily chart and just add all of the other sectors. So we look at stuff like the RSP, we'll put the Nasdaq here, we'll put the Dow Jones, we'll put TLT and the IWM. And you can clearly see it was a bullish day across the board. The S&P 500 up 0.91%, the Nasdaq 100 up 1.31%, and even bonds, yes, they were down pretty heavily on the day, but they pared a lot of the losses because we did see stuff like treasury yields, the 10-year treasury yield, because yields did fall after the data and Powell's comments. But, you know, even the IWM up 0.25%, the RSP up 0.45%, the Dow Jones up 0.62%. Not as strong as the larger cap names, definitely are still seeing mega cap leadership, large cap leadership. But it's good to see that these indices are also in the positive. And I believe if you actually remove Tesla from the Nasdaq 100 and its gains, it was very close to 1%, very close to what the S&P 500 did. So a lot of the movement in the Nasdaq was actually predicated on the Tesla. When you have a $650 billion company up 10% on the day, that's really going to move the market in a very significant way. But looking at some of our other parameters, the 10-year yield actually fell 0.69% today. But if you actually have a look at it on a peak to trough basis, you're looking at more than a 1% drop in the 10-year yield overnight, which is very, very bullish if you ask me. And later on in the video, I talk about yields and when do they become a problem, and it's here at this 4.6% mark. That's when yields really become a problem. So even if we do move up, you know, and stay below the 4.6 mark, we still should be fine. It's 4.61. That's when yields really become a problem in the 10-year yield. Now looking at commodities did move as well. Silver was up 1% here on the day. Gold was up 0.22%, but pretty flat here in the after hours. And then crude got to as high as 84, but actually finished at the low of the session. That's a very ugly candle if you ask me, especially closing below yesterday's close, now at the $82 level. Maybe we do see a little bit of volatility here in crude for the next couple of weeks. But let's dive into the S&P 500. Let's first mark out our key levels. Now the first key level we want to mark out is actually the call gamma resistance. Now this is at 5,600 right here. So this is our target into June OPEX. The next line that we actually want to mark off is the gamma flip zone, and this is at 54.45. Now what do you notice about price action in the last couple of days when it comes to the market, right? Very, very interesting. Right here, the gamma flip zone, we couldn't break below. That's obviously a bullish sign. The bears couldn't get us below. Bulls came in at this level and we saw a massive green candle. That's a very, very green candle. You can see that there was plenty of a buy side action at the top, but we couldn't close above the 5,500. We tried to at this point. Today, we did. As we exited the window of weakness, we're officially in the new month, in the first week, and a huge gain, and do expect this to continue. Generally speaking, the first 10 trading days of July are very, very bullish, right? And then we sort of trade flat. Go ahead and watch the end of the video in the seasonality section of the video. We talk about June seasonality, but it sort of looks something like this. That's what June seasonality looks like. So the majority of the gains are in the first 10 days, and that's actually what we're seeing. We bounced off the gamma flip, the 54.45, and now we're rallying, and do expect this to continue. We could maybe have one day of a minor consolidation, a minor pullback, and then we can continue the move upward. And ultimately, our goal right now is the 5,600 area. This is the area, the 5,600 is our aim into July's OPEX. So do expect a little bit of volatility. We could pull back, you know, here, but I do think that we're probably going to hold this 54.45 zone. If we do get back here, I'm a strong buyer, and then we'll go, but I don't think we are. I think if we are going to pull back, it's going to be very minor, and we're just going to stair-step our way into July OPEX here into the 5,600 area, especially if we get the NFP data that comes in line. So if you are a bull, you should really already be in here at the 54.45, as well as here at the 5,200 area and the 5,000 level right here. These are all areas where I said to buy. I also said to buy right here at the 54.45, the gamma flip zone. I think yesterday I said if we do get to the 5,400 zone, that's also where you want to be a buyer. But yeah, you want to be a buyer. I think we're going to 5,600 by July. There definitely will be a volatility, and I do think we're going to get there very, very quickly in the next 5 to 10 trading days. But I think we see the 5,600 area, and then we could maybe look to downside. But the trend is up. This is an all-time closing high. We officially closed above the 5,500 zone. That is bullish. 5,600 is the core resistance. We're definitely going to go higher. And look at this weekly chart right now. Super, super bullish on the weekly chart. That's a very bullish weekly chart when you look at it like that, right? And also on the monthly, very bullish monthly. And if we go ahead, hit that 5,600 area, close the month there, super, super bullish. You don't want to fight the trend. We are in an uptrend. You even look at stuff like the advanced decline line. We're starting to see an uptick. Look, higher lows in the advanced decline line moving up. Even if we compare it to the RSP, very, very bullish momentum if you ask me. Then you look at stuff like the relative strength index, and we are working off these overbought conditions. The S&P 500 continues to make all-time highs, while the RSP continues to actually trend downward. Yes, we are trending up, don't get me wrong, but we are seeing relative strength move in a downward direction. This is often a bullish sign for equities, which means there's more gas in the tank left for the S&P 500 if it does decide to continue its move higher. So I'm a buyer, I'm bullish, don't fight the trend, stay long, and just sit through the volatility. Let's dive into some stats. This is a summer rally set up for the next couple of weeks here in July, and pretty much it's when the second quarter OPEX, so the big quarterly OPEX, is positive and the June OPEX week is negative. What are the returns we can expect? We triggered this setup right here, and this is normally what happens. So pre the 4th of July, so pretty much the week we are in right now, the average return is 1.1%, 13 wins, 5 losses, 13 and 5, but median return 2.41%. Then we actually look at the 2 weeks that really matter to us, the 4th to the 11th and the 11th to the 18th. In this first week right here, the 4th to the 11th, 11 wins, 7 losses, so not quite as positive as this week right here. Average return 0.48%, 0.57%. So it's very, very 50-50 across the board, but then it gets ever more so better here in the 11th to 18th of July. 13 wins, 5 losses, 1.2% average return, 1% median. But if you look at everything in aggregate, 17 wins, 1 loss, very, very bullish. 2.79% average return in a 3-week period, 2.41% median. And this just proves July seasonality. You want to be long, you want to stay long. July is a very bullish month where we can see average returns in the month of July of 1.4%. Very, very bullish, and one of the most bullish months in the year. And this is aggregate performance from 1950 to 2023. Now we got Bofa's note here with regards to the first half 2024. We're going to go and read and just get their opinions on everything. Now they say don't sell in May and don't go away. The S&P 500 melts up 3.6% in June, plus 15% in the first half, and the S&P 500 made 31 all-time highs. The old adage, sell in May and go away, proved wrong once again, with the S&P 500 rallying 3.6 in June. Over the past 6 years, the index gained 2.2% on average in June, with 2022 being the only down June year, negative 8.3%. But we all know what happened in 2022. The index posted a strong 15.3% gain in the first half, the 83rd percentile gain for the first half, and was the second best first half in an election year since 1936. 1976 was the best, up 18%. There have been 31 all-time highs reached by the index, with 179 stocks hitting new highs. The US was the best performing region in the first half, outperforming international stocks, 11% in local currency plus 6% in USD. Stocks were the best asset class, followed by gold and cash. Corporate credit was flat, while long-term treasuries fell 4%. However, market breadth, very, very narrow. This is the third narrowest 6-month stretch ever. Only 25% of stocks in the S&P 500 outperformed the index year to date, marking the third narrowest 6-month period in history since 1986. The only other 2 times that were narrower was July 2023 and Feb 2020. Nvidia alone drove 4.6 percentage point of the S&P 500's 15.3% gain, while the Magnificent 7 drove 9.1%. Narrow market breadth isn't a harbinger of a sell-off, but we think it suggests the market is likely to broaden out. 10 sectors up, led by tech, real estate down. Tech up 28%, was the best performing sector in the first half, followed by comm services. The other 9 sectors all underperformed the S&P 500, with real estate being the only down sector. Financials were the third best sector, plus 9%, followed by energy. Now, a lot is being made out of the narrow market breadth. If you actually put it on a chart like this, you can actually see only 25% of stocks beat the S&P 500 going back to 1974. And we can see that the weight of the top 10 stocks in the S&P 500 as of June 30th is sitting at 37%. Kind of nuts when you look at stats like these. However, it's not necessarily a bad thing, because we got some weekly market commentary here from BlackRock, and this is with regards to market concentration and technology stocks. And they say strong balance sheets are also the reason we like technology. We are less concerned about valuation metrics. Free cash flow, excluding operational costs, as a share of sales are nearly double for tech than the broader market, and tech has the largest profit margins across all sectors. The concentration in US tech stocks is a feature, not a flaw of the AI theme. We stay overweight US stocks on a 6 to 12 month tactical horizon. and still prefer the AI theme. They also like industrials and healthcare stocks as gains broaden out. So BlackRock don't see the market just falling apart. They actually do believe that over the next 6 to 12 months, gains will broaden out. They like industrials, they like healthcare, but they do believe you also want exposure to technology. And I think that's very prudent advice. But let's say you come to me and you say, hey, Chase, I want to diversify my portfolio. You can look at stuff like bonds. Very interesting data here. Guys, this data right here is for municipal bonds. Discounts back above extremes usually means 12% gains. Average historical returns after discounts move back above the -2 standard deviations, 1997 to present. Munis are 2 standard deviations below their average discount, and in 12 months, this usually means 12.2% returns, 6 months of 7.5%, and 3.7% 3 months later. Buying at these levels where municipal bonds currently are, these are the returns you can actually expect. Another place to diversify your portfolio is definitely commodities, and specifically gold, because when it comes to rate cuts, gold tends to perform very, very well, particularly when the Fed stops hiking and then goes on aggressive cutting cycles. You can see in the early 2000s, Fed paused, cut rates, gold rallied 66%. Similar situation here during the GFC, the Fed cut rates very aggressively, and in a very short 6-year period, gold was up 189%. Here in 2020 during the COVID situation, up 50%, and this is where we are right now. We do know that the Fed have paused. The next move for the Fed is likely a cut, and we should see gold rally anywhere 50% at minimum if history is anything to go by. And guys, when it comes to the market and you see headlines such as these, stocks could fall 30% as US heads for a deep recession, analyst warns. This was on July 2nd. You just need to ignore these. This research analyst said in a note to clients last week, this analyst prediction hinges on the belief that the labor market will slow notably in coming months, which will weigh heavily on consumer spending. The relationship between inflation and unemployment is measured by something called the Phillips curve. And the analyst goes on to explain her points. But the truth of the matter is, it doesn't really matter. When you ever see doomsdayers on your timelines, you just need to look at something like this. This is essentially the performance impact of shifting $1 from the S&P 500 to the Barclays Aggregate Bond Index, measured from the week of the Armageddonist comments. So, all of these guys right here, they said, the end is near, the end is nigh. They pretty much came out and said it's the end of the stock market, the financial markets. And this right here is simply the opportunity cost of not having invested in the S&P 500. It essentially tells you how the S&P 500 outperformed the bond index, relatively speaking. And this is the subsequent return from going from the S&P 500 into the aggregate bond index. And so how is this charted? They measured the impact of an investor that shifted $1 from equities to government mortgage-backed and corporate bonds at the time of the comment. And the opportunity cost right here, had you divested, is anywhere from -30% all the way to -65%. So at the end of the day, if the market gives you volatility, sit through it, buy the dip. Doomsayers are simply just headline grabbers. So when should we actually get worried about the market falling apart? And according to 314 research, that point is 4.61%. That's when they believe yields begin to impact stocks. At the end of the day, the only thing that really matters in the market is interest rates.
Well, you've got to crank in interest rates, because everything and valuation gets back to interest rates.
Interest rates is the gravity that governs all. Warren Buffett said this. And when yields move to the 80th percentile, which is above this red line right here, the S&P 500 has tended to suffer. Right now, we're at 4.4%. This range right here is 4.61%. So when yields get to the 4.61% range, that's when we will see yields affect equities. But until then, until we actually get a move into this range, the market will continue as usual, because interest rates pretty much determine everything, including earnings. Now, I showed you S&P 500 earnings yesterday. Today, we're actually going to have a look at Russell 2000 earnings. And you can see here that we are expecting huge earnings growth here for the Russell in 2024, 17.92% for calendar year 2024 earnings, and then 33.35% for 2025. That would put the Russell at a 26 and 19.5 PE ratio. And the reason why small caps haven't had a rip your face off rally is because the market is waiting for these earnings to materialize. And we could definitely see that rally start here in the second quarter earnings season. I mean, growth is expected at -4.83%. If we get growth that's actually 0%, potentially just growth in the second quarter, expect the rally to start here in the second quarter and continue in the third and fourth quarter if these earnings show up the way they should. Now let's talk a bit about the US economy. This right here is GDP for every single state in the US. And I just wanted to show you guys this because GDP in every state is very, very strong. except 3 states. There's only 3 states where GDP is negative. It's Ohio right here, Maryland, and Rhode Island right here. Those are the only 3 states posting negative GDP growth. Every other state is in growth. Kansas is unchanged, and we have some very, very strong growth metrics in every other state here in the US. Another great economic parameter is actually the federal employment tax receipts. We got the latest data here for June, and this is very interesting. You can actually see a 5.6% increase year over year in June. In May, it was 8.1, 4.3% in April, 7.3% in March, 6.1% in February, and 1.4% in January. All in all, so far for this year, we're looking at about a 6.3% average, which is very, very strong, and this literally suggests persistently strong employment income and jobs growth. And we know this is the case because US non-farm payroll last month in June was 272,000. We beat the forecast, as you can see right here, and non-farm payroll growth has come in persistently above its forecast, except here in May. And we do get non-farms this week, and we need to see if this trend right here will continue. Now, the expectation is for 195,000. That is the consensus. You can see that was the previous number, and this number right here, 195k, should put us at a 4% consensus unemployment rate, and we're looking for average hourly earnings of 0.3% month over month. And if we do hit these figures, if they do come in line, we do expect the market to continue higher as per June seasonality, which pretty much is just a higher highs, higher lows, average return 1.3% in June. Now, looking at the overall presidential election cycle seasonality and what we've done in 2024, you can see that we've actually completely outperformed the average election cycle from the post-election cycle, midterm, pre-election, and the election year. And it's very, very weird because we outperformed significantly here in 2021 during the everything bubble. Then we actually underperformed it into the midterm cycle, and then part a lot of the underperformance gains we saw here in this pre-election year last year. And now in the election cycle, we are tracking well above seasonality. And listen, trend is more important than level. It doesn't mean we're actually going to pull back to this level. You can actually see that normally we do actually get a little bit more gains here in the presidential cycle, and that probably stands true for the S&P 500. We probably do go higher into the year, but definitely not without volatility. And lastly, looking at liquidity conditions, very, very interesting. We're pretty much in the exact same state. United States is between the bid and puke zone, so liquidity is neither hurting or supportive of equities, but it can get really bad really quickly, particularly if we get to this puke zone. And we saw what happens when we get below the puke zone. Recently, Europe has come under pressure. Now, I do understand there's election concerns with that, but the second liquidity becomes a net negative for the markets, we can actually see some downside, and this is where we are in the US markets. I will keep you guys updated with liquidity, but do keep this in mind.